Hello traders, and welcome back to our Babypips course. For today we have completed course 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and I am excited to have the privilege of having course 11 discussed with you today. So here we are on graduation, course 11 of 11 on the series so far. So we are on graduation, and the course outline says the most common trading mistakes new traders make: forex trading scams, personality quizzes, graduation speech. So the very first item, which is the most common trading mistakes new traders make, is what we are going to discuss, and we're going to consider these subtopics under here. The deadly O's of trading, what traders do to guarantee their own failure, then how to lose all your money in your trading account in 10 days or less, and then tips for forex trading beginners, and then lastly, what makes a good trader. So these are all we're going to consider in this very first lesson, and to begin with, let's roll the intro. So here we are on the 5 deadly O's of trading, what traders do to guarantee their own failure. So do you know the 5 deadliest factors that cause traders to fail are self-inflicted? Okay, many traders, they cause their own trading downfall. How so? Through their trading account. So let's not talk of all of all. Let's go to the meat of the discussion. Okay, what is the meat of the discussion of this section? So it says a lot of traders have eaten this metaphorical cereal, like overeating cereal that can hurt you. Now, what are the 5 O's? Now the 5 O's are: 1, overconfidence; 2, over trading; 3, over leveraging; 4, over exposure; 5, overriding stop losses. Okay, so since this is graduation, I think it's pertinent for us to actually discuss and consider all these one at a time, trying our best possible to explain what it really means, so that it can sink down into our minds and hearts. So what is overconfidence? You simply know that what it means. It is characterized by an inflated belief in one's own trading skills. Okay, well, it's easy. Oh, I seen it, I know the setup is good, it's head and shoulders pattern, is double bottoms, I'm gonna trade, and even though the trade is going wrong, okay, you still say no, you still insist on your trading skills. Why? Seeing what is happening right before you on the charts. So confidence is critical for every forex trader to become successful. But when you are confident, you are more likely to take risk or look for opportunities. Okay, so no matter what happens to you, okay, no matter what your trading knowledge is so far, try your best possible not to be overconfident. Okay, because overconfidence can actually eat you. Okay, the overconfidence effect is a cognitive bias in which someone believes subjectively rather, that his or her judgment is better or more reliable than it objectively is. Okay, so the overconfidence effect is a cognitive bias in which someone believes subjectively that his or her judgment is better or more reliable than it objectively is. So basically, when your confidence is high, your opinion of yourself is higher than what an impartial and rational person who is not in your shoes might think. Okay, given the same fact that person is saying. So psychologists have observed overconfidence in 3 distinct forms: overestimation, which is the tendency to overestimate one's performance; over precision, which is the excessive confidence that one knows the truth. Okay, and over placement, which is a judgment of your performance compared to another. So said differently, overconfident people or traders believe that they are better than most and overestimate the precision of their knowledge and the level of their abilities. Okay, so we actually want to, avoid these traits because it's going to lead us into a downfall if we are not careful. Okay, so let's say you are asking, drivers, every drivers, if they think they drive, more than above average. Every driver will tell you, yes, I drive more than above average. Okay, so if they actually do drive more than above average, why is it that many drivers still get, involved in ghastly motor accidents? So, no matter how skillful you are in trading, don't be overconfident because just as a driver, anybody can get involved in a vehicle accident. That doesn't mean they don't know how to drive, but it just happens. So too it comes with trading. Okay, so you don't want to be too confident and stick to your gut. Like, okay, I know this is what's going to happen. It must be that way. If no, there can be an accident. It doesn't mean you don't know how to drive, but keep your confidence level normal. Okay, so to minimize the effects of overconfidence, okay, you must take your time to truly understand yourself and what you are capable of achieving. You must also be aware of your limitations and what opportunities are not worth pursuing. Okay, most importantly, you have to consider the possibility that you might be just wrong. Listen to the new evidences that the chart is printing out for you and use that to make a confident trade. Okay, but you must try to be balanced with intellectual humility. So when you see the chart printing out different counter information that suggests that what you have thought out is going to be wrong, just accept it, even if you are losing. Okay, accept it and move ahead. Okay, take it out. So here's some intellectual humility being given to you. Now let's talk about the second O of trading, which is over trading, which includes revenge trading. Now, overtrading is when you trade too frequently, taking extremely large trades or taking uncalculated risk. Okay, so what matters is not even the trades you want to take, okay, but protecting your capital so that you will have better odds of entering the market again. Okay, successful traders are those traders who are extremely patient and they wait for quality setups to materialize before and they take any execution. Let's take that again. Successful traders are extremely patient, they wait for quality setups to materialize on the chart, and they also wait for a confirmation which gives them that entries. Okay, so when you do this, you'll be protecting your capital and you have all the odds in your favor. Okay, so you will know you are over trading if you close a trade on a loss that is deep down, like you take too much loss on a trade, that you're over trading. Okay, if you feel that you shouldn't have taken the trade you have taken, you are also guilty of over trading. So please avoid over trading. Don't try to revenge trade, don't try to force a trade. Okay, you can be over trading when you do this. Look at the chart, for instance, see how many lines and all that. You are over trading when you are stocking up, because when you do things like this, okay, you try to create what is not even there in the first place. You try to bring out more thoughts, interpret more things which is not even happening in the market. Okay, and that's so terrible. Okay, so don't try to force a trade. And you know what happens when you spend so much time watching the charts? Okay, you're trying to force the market, you're trying to force a trade, you're trying to force an entry. Okay, do not look into the market or sit down in front of the computer 1 hour, 2 hours, 3 hours. No, because what that will do for you is going to mess up your psychology, your mental process. Okay, you'll be urging to want to do something that you shouldn't actually do just because you are constantly watching the charts. Okay, so revenge trading is what we have just talked about. You lost the trade and you're trying to get the money back or your loss back. Okay, when you do something like this, you actually hurt yourself. So revenge trading, in revenge trading, you're not trading with your brains, you are trading with your heart, because you're becoming so emotional. And people who trade with emotions, they actually don't go far in, in this business, my friends. So I tell you, so take a trade, let it happen, let it play out. Okay, and let it is what it is. If it goes in your favor, fine. If it doesn't go in your favor, close the trade, close your chart, don't trade that again anymore. Wait for the next day, come back to the market, okay, with a fresh state of mind, okay, and being objective. Okay, so when you start thinking freshly, having fresh thoughts in your mind, you see that you become more objective, you become more relaxed, more calm, and you're more very 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 much more happy with yourself. So how do you avoid of having revenge trading? You have to be fully present and fully focused while trading. You have to make sure you are in a good state of mind and not currently filled with negative emotions such as anxiety, apathy, fear, greed, or impatience. Okay, you must have a trading plan and stick to it. Always trade in a methodical manner. There's no place for random improvisation when you enter or are about to take a trade. So, if you want to become a successful trader, you must think the long term. Okay, don't think about the short term losses or the drawdowns or the accounts you have blown. Give yourself like 5 years from now, and walk the process. Okay, like Rox will always say, he says, trust the process. Okay, so what is the process? The process is actually the patience, the time it will take you, and all the journey through the emotions and everything you have to go through to be able to become a proficient and consistent profitable trader in the long run. So it's not about the profit you want to take out of the market right now. It's about trading consistently, doing the same things over and over again for a period of time until you get a firm hold on the skill of this business. So trading is a game of patience. Okay, traders who wait for quality setups and sit on their hands in between are the ones who will end up profitable in the long run. So focus on the profit, on the process, and not on the profit. So over leveraging. So what is over leveraging? We've talked about leverage before now. Okay, so we have also said, people, traders who take lots of leverage have, they are exposed to much more risk, and they are also paying more for the cost of trading, because they are actually being charged more, because the leverage is like your broker giving you much more money and it's not for free. Okay, so you have to pay something. The rate for that is the ratio of the amount of money you pay to be able to execute a trade with that leverage costs something significant as well that can harm your account. So it is not all too good to trade with high leverage. Now if you haven't watched the video where we talked about leverage, please do so and go back and watch it. Now the advantage of using leverage is you can magnify your gains, okay, with a limited amount of capital, right? But the disadvantage is that you also magnify your losses and you can quickly blow your account. Okay, so be careful of the leverage you use, and try to master leverage very very well. Let's read this, what it's saying. Say, I'm mad at you because the value of my trading account is so volatile because of the leverage. Okay, right? So yeah, that's that. So the higher your leverage, the greater your risk on each trade, likely resulting in irrational decision. So knowing the link between leverage and your account equity is crucial, since it determines your true leverage. Now in this chart, you're going to see the percentage of traders and their success rate in trading with regards to the leverage they choose. So from the chart, you see 40% of traders, okay, using a true leverage of 5 to ratio 1. Okay, the traders who used a leverage of 5 to ratio 1 had 40% success and wins in their trades, compared to traders who used 25 to ratio 1. Look at their win ratio is just 17%. Okay, so you can see that using a true leverage is actually beneficial to you. And the smaller your leverage, the higher the amount of money you have to put into your trading account. So use true leverage of 10 to 1 or lower. Okay, only risk 10% or less of your account balance at any given time. Never let the value of your trades open never let the value of the trades you open exceed 10 times your account equity. Okay, like this guy here, he's talking to a doctor and he says, I realize that my blood pressure stays low when I keep my leverage low. And of course, that's what's going to happen to you as well. Okay, you'll not be scared of losing or blowing your account. Okay, so let's just take this together. It says, for example, if you open an account with 5,000 US dollar in equity, a 10 to 1 leverage would mean opening positions no larger than 50,000, divided by 5 mini lots or 5 macro lots, okay, at a time. Okay, so that's actually significantly low. So having access to a high leverage doesn't mean you need to use it. Okay, right? So get that in your mind. Now let's move to the next I think this is the third one, overexposure. Right? So what is overexposure? Overexposure is actually when you're taking multiple positions. Okay, when you open multiple positions in your trading account and each position consists of a different currency pair. Always make sure you are aware of your risk exposure. Now, because both of those trades, like in this scenario here, say, both of my trades got stopped out at the same time. So for instance, let's say most of the currency pairs you are trading, let's say AUD USD and NZD USD, it's actually like having two identical trades open because they usually move in the same manner. We talked about correlation of pairs the other day, and if you haven't watched that video, please go back so you can watch it. So if you take two positions, for instance, you opened AUD USD and you open another position at NZD USD, you are actually overexposing your account because these two pairs, they work in the same direction, they go in the same direction. So why not just pick one and let it be? But if you do two, you open a position here and you open a position here, you are actually overexposing yourself to the same currency pair, to different currency pairs, but all going in the same direction. That's your overexposure, because if one thing happens to this account, this trade here, invariably it will happen to this trade here as well. So instead of reducing your risk, you are actually magnifying your risk. Unknowingly, you are actually exposing yourself to more risk. This is known as overexposure. Now look at this currency correlation chart. Look at AUD USD at the top, blue, and look at NZD USD at the bottom, red. They are actually moving in the same direction. So try your best possible to look at the currency correlation measures and how two currency pairs move in the same direction or opposite direction or totally random direction over a given period of time before you actually take a trade. Now, overriding stops. Is another deadly O's traders use, and this one actually affected me for a very long period of time. So stop losses are pending orders you enter that effectively close out your trading positions when losses hit a predetermined price. Now it might be psychological because it can be psychologically difficult for you to acknowledge being wrong or accepting your losses, but swallowing your pride can keep you in the game longer. So overriding stops is actually when you see price trying to come and take you out in a stop loss and you move your stop loss higher and you think, oh, maybe my stop loss is too high, it's too tight, let me just advance it, push it up a little so it doesn't close me out, and by the time you're doing that, you are actually overriding your stops. By so doing, you are going against your trading plan, and you shouldn't be doing that. So you should have a strong mental toughness and self-control to stick to your stop loss. Do not move your stop loss, no matter how hard it is, no matter how much you are going to lose. Your stop loss tells you yourself that your analysis which you have done is wrong. So do not adjust the stop loss to take in more losses again. That is actually dangerous to your account. So if market has reached your stop loss, your reason for taking the trade is no longer valid and it's time for you to close it out. Okay, do not override your stop loss, or worse, remove your stop loss. Okay, just let it ride, let it hit your stop loss, and then your account drops. Okay, and fine, you still have something to go with in the next trading day. So widening your stop is basically like not having a stop at all, and it doesn't make any sense to do it, because at the end of the day you are going to burn your account. So these are the 5 O's of trading: 1, overconfidence; 2, over trading; 3, over leveraging; 4, over exposure; and 5, overriding stops. I hope these 5 O's you find them beneficial. Okay, so if you do, smash the like button and hit the subscribe, and let us go to the next lesson that says how to lose all the money in your trading account in 10 days or less. So here we are, traders, on how to lose all the money in your trading account in 10 days or less. Like, if you really want to lose all the money in your trading account in 10 days or less than 10 days, do these following things. Step number 1, buy a super expensive computer. Okay, so buy like a 27-inch ultra HD 8K monitors and mount them in your house, and put all those CNBC routers or what have you, and be staring at the charts and things like that. Buy all those luxurious stuff, like gadgets and everything. Pile up your bills and all that. That's step number 1. Okay, and then step number 2 is focus on trying to find a perfect technical indicator. Okay, so when you find a perfect technical indicator, you just install it in your machine, and you automatically have an ATM machine in your kitchen, and you'll be making all these huge lots of money, coupled with your ultra HD 8K super computer monitors, blaring out this green lights and beeps, and telling you you're gonna buy, and you make lots of money. Do that. And step number 3, for you to blow all the money in your account in 10 days or less, is when your technical indicator says that the currency pair is oversold, buy it right then and there. Okay, just a click of the button and you have bought it. Okay, your brain has nothing to do or has no match with the indicator. Now step number 4 is don't pay attention to the current or future economic outlook of the world's biggest countries. Okay, so don't read the news, don't read what's going to happen tomorrow, don't read if central bank is going to release any news, don't read about NFP, non-farm payrolls, don't read about news in UK, US, Europe, and all that. Don't do that, they are all boring. Okay, just be there, look at the charts, click buy, click sell, and things like that. You're going to make a lot of money. Yeah. Then step number 5 on how to blow your account in 10 days or less is make sure to visit a bunch of forex trading forums and go through all the threads until you find hot trading tips. Okay, I think that's self-explanatory. Just do that. Okay, now step number 6 is that you should read what other traders are doing and be sure to follow them without question. Okay, just follow them. You literally need no brain to do it. Okay, so you can figure out, you just find out a forex trader, follow them and do whatever they are doing. Yeah. Then step number 7 is keep creating a trading plan. If you see a good trade, just do it. Click buy or sell. Don't create a trading plan. Okay, entry, exit, stop loss, none of that. It doesn't matter. Just buy or sell once you see a setup, right? Yeah, that's step number 7 on how to blow your trading account. Then step number 8 is dream about how much you will make, not about how much you will lose. When you dream about that, oh my goodness, you are going to make a lot of money. Okay, so you make money that will be able to help you to buy a Ferrari, buy the Gucci, buy the Hermes store, and the dealership, the good car, and all that. Okay, how much you need to make in return is very, very important. So do that, and you would have completed the 8th step on how to lose your trading account in 10 days or less. Then the 9th step is don't set stop losses. That's for losers. Just put in the trade, trust your gut, be overconfident, do all the 5 O's plus this, yeah, you're gonna win. Like DJ Khaled, all I do is win, 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 no matter what. It's gonna be good for you. Like many people say, setting stop losses is for losers. I know how the market works and all that. Really, really being overconfident. And step number 10 is make trades or take trades based on your emotions. Okay, no need for logic. Okay, simply rely on your consistently dependable emotions and hit buy or hit sell. Trading emotionally is how you will pile up winning trades after winning trade, and at least that's how you feel, right? So the final tips is make sure to perform as many of these steps as possible, and very soon you will be seeing that a big fat zero under your account balance that you have always dreamed about. Okay, and if you are really impatient and you want to lose your money even faster, feel free to repeat any of the individual steps vigorously. But if you want to avoid blowing your trading account in 10 days or less, know that you don't have to do any of those 10 steps we have just considered. But if you want to blow your account, like if you are really sure you want to blow your account, okay, in 10 days or less, practice any of these from number 1 to number 10. I can tell you what, I can promise you, BBPs is promising you and I that if we do any of these, we are going to blow our account in 10 days or less. Okay, so I think you should have this as a 10 commandments of forex trading, okay, plus 5 over the 5 O's. Okay, so a lot of traders have made these mistakes when they first started trading, including Babypips itself. So hopefully you're not going to follow these footsteps, because if you do, you are going to blow your account. So that brings us to the end of this lesson. Let's move on to the next lesson that says tips for forex trading beginners. By the way, if you have not clicked the like button already, please do so. Okay, the like button you are clicking, it helps with the algorithm. It helps with Google to be able to show this video to more forex traders, new or old as well, who haven't completed Babypips course and they want to do so in a very quick way. Okay, so hit the like button for us. Okay, drop a comment if you want to, and I'll see you in the next lesson that says tips for forex traders, for forex trading beginners. So traders, here we are on tips for forex trading beginners. So I want to consider some tips that will be very, very useful to you and to all of us. Tip number 1, educate yourself. Okay, we can't overemphasize the importance of self-education and learning as much as you can about the forex market. Okay, find quality education courses or sources like we have in the School of Pipsology, which we have been learning from. Okay, so continuously educate yourself before risking real money in the market. Make sure to study the current the different currency pairs and understand what makes their prices go up or down. Okay, make sure to study the different currency pairs and understand what makes their prices go up and down. That's number 1. Then number 2, create a plan and stick to the plan. You are the most rational before placing a trade and most irrational during your trade. Okay, so you always need to have a plan before you open a trading position. Okay, so creating a trading plan is very, very core component of a successful trader. Now, a trading plan is an organized approach to executing a trading system that you have developed based on your market analysis and outlook, while factoring in risk management and personal psychology. So with a trading plan, you're able to know if you are heading in the right direction. Okay, you'll also be able to know and to measure the framework of your trading performance. Okay, and you can always continue to do this. Now, number 3 is practice. Practice. Okay, choose a currency pair, trade with that currency pair, especially on a demo account. So practice on a demo account for a very long period of time until you see that you are consistently profitable with the trading system, the trading plan, and your own psychology. Okay, then put in real money before you go into the live market. Okay, so that's step number 3. Step number 4 is keep it slow and steady. It is a process. Okay, so the more you continue to educate yourself, the more you have created a good trading plan, okay, the more you stick to the core disciplines, okay, and principles of discipline. Okay, when you are so disciplined and you're doing all this together, you find that you position yourself on a better edge of staying, profitable in the market. So it is not a sprint, it's a marathon. It takes time, it takes consistency, okay, it takes knowledge, it takes patience, it takes emotional stability, before you'll be able to see good and great results. Okay, so keep it slow and steady. Tip number 5 is know your limits. Okay, so before you actually risk your actual money in your trading in the forex market, okay, you have to set limits and boundaries for yourself. Okay, you have to, okay, this money you want to put into the trade, into trading. Will this money actually will it actually be useful for me to pay my bills, to feed, or to buy something that I really need? Okay, think about all this before you actually put the money into a live trading account, because it is not easy to actually flip that money for, let's say, 100 into 200, or 5,000 into 10,000, or 5 into 7,000. The chances are that you might actually lose the money. Maybe lose 200 or 500 or 1,000 or even 5,000, depends on your knowledge and trading experience. Okay, so know your limits, know how much you are bringing to the market and how much you are willing to risk from that capital you are putting into the live market. Okay, and consider the factors like leverages as well. Then number 6 is keep your emotions in check. Okay, do not trade out of emotions. Take your emotions out once you have executed your trading plan. Okay, that way you'll be very, very stable in watching the market, and you'll be able to make good rational decisions and stay emotionally detached from the markets, because the market will always do what it has to do. Now, step number 7 is stay open-minded. Do not bring your thoughts and your knowledge and try to force it on the chart or the market and say this is what it should do and it should do that. You will not be expecting that. No, you are not in control. We are just like ants. Retail traders are like ants in this business. Okay, the big boys control what happens and how price moves in the market. So asking questions enables you to look at different perspectives of the market that you initially may not be aware of. So this practice will make you think of other potential scenarios that may emerge and enable you to become a better listener of the market, rather than an imposer of your own thoughts and views that in reality may not mean zilch to the markets. Okay, so view everything that is happening in the market as potentials. It has a potential of hitting stop loss, it has a potential of hitting my take profit, it has a potential of reversing at this level, it has a potential of pullbacks. Okay, that way you'll be questioning what is going on, and it will open your minds, okay, and make you to stay open-minded to see different scenarios that might be playing out, rather than imposing your own thoughts and views, okay, that in reality means nothing to the forex market. So if you find this very beneficial to you, okay, please smash the like button, okay, and drop a comment below. Okay, so let's move to the next lesson that says what makes a good trader. So traders, here we are on what makes a good traders. There are some habits that separates good traders from bad traders. Now, a good trader realizes that trading is patience, discipline, and requires a trading approach that is adapted to their specific psychological profile, or you can say adapted to their personality. So a good trader concentrates on the process of trading and not just the results. So what do good traders do? Good traders know that they must have a good and sufficient risk capital in order to achieve their financial objectives. Okay, good traders also act according to their own judgment. They think for themselves rather than blindly being influenced by others. Now, a good trader never trades on hope. They don't trade on hope. They analyze the market and take calculated risk. Now, a good trader stays out of the market when in doubt. A good trader does not chase the market. Okay, they will wait for signals to appear based on their market analysis and trading strategy. Now, a good trader does not overtrade. A good trader does not fight against the trend. Why they may trade pullbacks or counter trend swings, they are aware that this price movement is temporary. Now, a good trader always knows the risk to reward ratio of every trade. A good trader cuts their losses instead of hoping that the trade will turn around in their favor. A good trader allows their profits to run until an exit signal based on their trading system is triggered. Now, a good trader always analyzes their closed trades to find any lessons on how they can improve. A good trader is patient and knows that there are periods when they don't need to trade. A good trader also never widens a stop loss. They never cancel stop losses, and a good trader treats each trade separately. And a good trader also exits the market when in doubt. And finally, a good trader does not blindly follow the advice of traders. So these are what good traders do, and that brings us to the very end of the very first lesson of undergraduation 10.1. The most common trading mistakes that new traders make. So I believe you find this beneficial. If you do, please smash the like button, subscribe if you haven't, and until next time, I'll see you in the next lesson.